Hey everybody, Doug Robertson here. Looking to give you some ideas and insight into trading options in a low volatility or low VIX environment. Right now, as I'm sure all of you have been paying attention to, we are in one of the most low volatility environments that we've seen in an extremely long time. We've had the SPY, SPX, SP 500 market in general going up for a long time, and for some reason, I'm not entirely sure that I agree with it, the volatility has been dropping down to historic lows. That is creating a situation where we have to rethink the way we do certain types of trades. Whenever we're trading, we are using the options to basically capture an idea that we have on what's going to happen next in the market, whether a stock's going to go up, go down, go sideways, or more advanced, how's the implied volatility going to change? Now, we're sitting here in a market with a VIX down near an absolute absurd low. Right now, as I'm looking at this, VIX is trading at 1172. Recently, we had a low of 9.97. Now, volatility is not like a stock. It can't go to zero. It has some true bottoms in it. The market makers, the sellers of options, will not sell options unless they feel like they can get enough money out of those options to pay for the risk they're going to take. They won't go too much further below that. VIX of zero, which is basically impossible without the market shutting down, will not happen. What happens is that we do have periods of time when there's not a lot of people buying into options. Volatility drifts down till the sellers get to the point where they're no longer willing to sell anymore. Buyers aren't really picking up the slack. Bid-ask spreads widen, the midpoints drop down, and we see the volatility in the market drift lower and lower. These are times when we have to change our thinking. We have to pull out a different set of tactics. A lot of you like to use vertical spreads. I love them. They're great trades. They are really useful in a wide variety of different situations. Bullish, bull put spreads, bear call spreads, even going on to iron condors for sideways. But in the market we're in right now, they don't tend to work very well. There's a lot of things going against them. So we're going to dig into that in just a second. Before we do that, I want to show you what the reality of this low volatility environment really is. Let's skim through just a selection of stocks. Some of them are bullish, some of them are bearish, but I want to take a look at one specific aspect of them. This. Actually, let me turn this down a little bit. All right. This is a tool that I use for evaluating where stock is within its own implied volatility range. This becomes a pretty important driver for my decision making when I'm creating trades. Now, I can see the implied volatility on the symbol. I can see the historical volatility. And I also have this little dot right here, which is measuring what the percentile rank of implied volatility is. This is looking back over 400 days of trading and calculating how many times implied volatility has been above the current implied volatility and how many times it's been below. That determines the percentile rank. So right now here on Applied Materials, we have a percentile rank of 1.8%. That's incredibly low. It means that only 1.8% of the 400 samples for the last 400 trading days, almost 2 years, has implied volatility been below the IV that we've got right now. We're seeing this across the board. It's all over the place. Let's take a look. Home Depot, percentile 4.3. Ralph Lauren, it's in a steady downtrend. This should have a high implied volatility. Nope. Percentile 1.3. SodaStream, going up. Okay, great. Percentile 0.3. Big companies, small companies, Disney, 4%. This is the fourth percentile. Only 4% of its previous implied volatility samples have been below this. And let's see. MGM had a bad earnings, dropping down significantly. And here they are with a percentile of 2.3. Normally you associated a bad earnings and a dropping price with high implied volatility. Not today. Markets can get out of whack. So let's pay attention to that. Let's see how we can use that to make our trades better. So in just a second, I'm going to show you some different types of trades, how they react in different environments, and what might drive your selection of the trade you want to use to make money off of the ideas you have in the market. Okay, let's take a look at example number 1. In this case, we're going to be using a bull put spread to trade Applied Materials. Basic reason for the trade, it looks like a good solid trend. It's heading up. We're going to try to use that to make some money. Our belief is that this stock is going to maintain its trend and keep going up. Reality is that that could change. It could go against us. So we need to be able to manage the trade and deal with the trade if it fails. We're going to set this up as a basic vertical spread, bull put spread, and we're going to use a fairly short time frame just to use to make this example kind of understandable. I'm going to be using the March expirations, and in this case, I've already set up a trade, and we're going to analyze it. I'm using a 35 strike put expiring on March 17th. That is short, with a long 34 strike put expiring on March 17th. Between the two, that gives us a 13-cent credit, giving us basically an 87-cent margin. Reasonably decent return on investment over the period of time we're going to be doing it. That's not the core point of the trade, though, or the analysis. What we want to know is, how is this trade going to be affected by changes in implied volatility, and why isn't this trade necessarily a good one for us? Well, first of all, if you take a look at the stock itself, we are currently trading at 36.36, and the strike we're using is right here at 35. All it would take is a very, very small pullback, and we are going to be below our strike and losing very quickly in this trade. But if that were to happen, a second thing would likely happen. Implied volatility would very, very likely jump up on this trade and hurt us. So let's take a look at what would happen in that situation. So let's assume that we dropped from 36.34, where we're at right now, down to 35.38. I was aiming for roughly a $1 drop. Not outrageous in this situation, not too crazy. Decent sized drop, and given the market conditions, that could happen any day. If we were to do that, we would be looking at a fairly decent loss. Now, on the 10 contracts I have in this example, which is a small trade, we'd be losing $144. But what we're not taking into account is the fact that implied volatility is at the bottom edge of its own range. So let's see what happens to this trade. Remember, $146 loss if we add in about 7% implied volatility. Now, this only brings us up to an average of about 30% IV, and on Applied Materials, that is well within the normal range. In fact, that's where we were just recently. So add in 7% IV. Now, may not seem like a huge amount, but we just added a significant loss to that trade. We accelerated the speed at which we were losing money. IV going up not only makes it so that our strikes are closer to the current price of the stock, putting us at a higher level of risk, but as implied volatility increases, it hurts our trade and makes us lose money faster. Not a good thing. We want to avoid this situation. It puts us at a disadvantage. We don't want this trade to lose worse if things start to go against us. So let's take a look at trade number 2 up next. In this example, I'm going to be using a different style of trade. We're still trading Applied Materials. We still believe it's going up. We still have roughly the same time frame. I'm looking at the March 17th expiration. But in this case, I'm going to use a calendar trade, and this specifically an offset calendar trade, to capture a profit if the stock does what we believe it's going to do. The difference between the calendar trade and the vertical spread, the bull put spread that we tried before, was that the calendar trade is long volatility. Now, this is one of the biggest features of using a calendar trade. If applied volatility goes up, it has a benefit to the trade. So, as a really rough analysis, I needed to make a couple of decisions. I believe that Applied Materials is going to maintain its general trajectory. It's looking like it'll cross over about 37.50 on the 17th. If it stays roughly in the same direction, obviously it's going to wiggle around a lot. I'm going to play it just a bit conservative. I'm going to go for 37. That's the strike I'm going to use. Let me show you the trade I'm setting up. Now, I've already built this. Basically, we used a March 17th expiration short call with a 37 strike. That is our target. Now we need to protect that. We received a credit on this. We need to protect it by going long. Same 37 strike, just 1 week later. We're keeping this nice and simple. It's just an example of how a calendar trade lines you up with volatility much, much better. Very cheap trade, 14 cents. We could leverage this up quite a bit if we felt like it. Going back to the analysis, let's take a look at what this trade looks like. All right, right off the bat, now remember, we are trading at 36.38, and before we were looking at 35.38, and we were going to be taking a fairly serious loss at this point. Well, in this case, it's pretty much the same loss, but there is a big difference. Actually, there's a number of big differences. First of all, if the stock goes up in the direction we want, heading towards that 37 strike, we do have to be careful it doesn't go too fast past this. As time passes, we add in a lot of profitability in this. And you'll notice that we could be making a very, very high return on investment in the middle of this trade if we're just about right, hitting the middle of this trade somewhere in the right period of time. So right here, we're looking on the 12th. This is, the trade ends on the 17th. We would be looking at making $72 on about $130 trade. That's pretty good. That is, 55-60% return. And down here, we'd be taking a loss at that same point we were looking at before, which was 35.38, basically a $1 drop. But here's where the magic of the whole thing comes in. We now have a trade that is lined up volatility-wise to what we believe is going to happen in the market. And this changes everything. So, once again, the stock starts moving against us. Or maybe volatility jumps up for its own reason. We don't know. Volatility being this low gives it lots of possibilities for moving up. But let's just assume that the stock dropped back to 35.38. And because of that, implied volatility jumped up to a more normal level of about, let's add in about 8% implied volatility, 9%. That brings us up to just about 30, which is what we were working with before. Boom. Now, what just happened here? The long option, which expires further off into the future than the short option, has more sensitivity to a volatility change. It goes up in value, and it goes up in value a lot. The short option, as we get closer to the expiration, is going down in value. It would get hurt by increase in implied volatility, but much, much less because its vega is much smaller. Overall, it creates a situation where the profitability on the trade shoots way up. But more important is the fact that if the stock had dropped down to 35.38 or even down to 35 or even further, we would have been protected. The trade fails gracefully, and in a lot of cases, it fails wonderfully. We would have been making about 46% or $46 on $130 trade at the point where we were basically getting knocked out of our vertical spread before. The implied volatility increases your chance of success. It gives us a lot of opportunities to not just get out with a profit, but control our risks when and if things fail. So, quick little tip. When you've got a market that's got low implied volatility, low VIX, everything is trading at the very low end of its own implied volatility range, shift your strategies. Look for the trades that are long volatility. Calendar trades are outstanding, can be a great tool in these situations. So there you go.